Welcome to the Dividend Talk podcast, episode 42, quarter one portfolio review. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you are new to this channel, please hit like and subscribe to us, and check us out on YouTube and Spotify. See you on the inside. Good evening, European DGI. How's your week been?
Actually really good. Busy at work actually this week, so I didn't do a lot on the dividend investing front. No blogs or anything, but I had quite some good and nice stuff at work, so I feel quite, accomplished for this week. How about yourself?
A productive week. For me, it's been the same as usual. The sun is shining. We have a week of sun, so we're trying to enjoy that as much as possible. The clocks, we've gone into summertime, so we have extra stretch in the evenings, as we say here in Ireland. So it's all good. It's all good at the moment. Looking forward to the weekend. It's a bank holiday weekend here, so we get an extra day off.
Yeah, it's Easter, right? The same here. So on Monday, it will be all with family as much as we can, of course, during this COVID-19. But I hope also on a nice sunny day, maybe tomorrow, to work a little bit outside in the garden or so.
Cool.
So, anything that caught your attention this week in the news?
Yeah, of course. Walgreens, one of my favorite companies, as we all know, reported some earnings, and it seemed to please investors because they had a nice little increase in their share price this week. But for me, it's been positive. Their half year report, their sales are up, I think 4.8% based on this time last year. Boots.com is doing really, really well. It's up over 100%. Free cash flow is up, and they're on track to open 40 Village Medical locations by the end of the summer. So they're doing really, really good. The pharmacy is still performing well. It's well outpacing retail, but I mean, we're still coming out of lockdown, so we expect retail to maybe catch up maybe next year or the end of this year. But really, really positive outlook. I mean, I'm so bullish on them, and I've been behind these from this time last year, so really happy to see that they are progressing well.
And this stock has been doing you quite well, right?
Yeah, it's probably one of my better performing ones. I think Royal Dutch Shell, we'll discuss later, is probably the one that's outperforming it a little bit.
Yeah, and you bought Walgreens also as a value investing play, right?
Yeah, they were $32 or $33, so I got them pretty much at the bottom. I mean, for me,
Nice.
there was more upside than downside, and that's how I felt at the time.
Cool. That's really good to hear, and nice to see, because I remember when we were talking about Walgreens that there was some uncertainty around it, and I remember, and it's always, I still remember how the heat in the moment was for you, and then to hear now that it's actually turning around is quite a good story.
Yeah, I mean, look, it's still a long-term play, so it's only in the short term. They're just making the right moves to me, so it's positive, but it could all go down to Swanee quite quickly as well. So just keep an eye on them.
Yeah. So my news of the week is, I mean, I have to stay with the topic of last week, the chip industry. I mean, TSMC announcing $100 billion investment over the next 3 years. And I thought that Intel with 20 billion did already a lot. Well, they passed by and 5 times more. It's insane what's happening in this industry at the moment. Really insane. I also heard again more news about car manufacturers and other manufacturers that are in a high need of chips, just putting their manufacturing lines on hold and such for a few days.
Yep.
It's insane what's happening at the moment. Really insane. I just don't know how to play this story here, because we have the Kleine Kapitalist also. He brought up ASML again. It is so fucking expensive.
Yeah, it's really hard to justify paying out, what's it, 700-800 euro on that. But I mean, there is a massive shortage at the moment, and I spoke to you off air. These chips are going to be in everything. We're going to need so many of them. Even humans, we might even get chipped one day. Who knows?
Yeah, but if this is the case, then probably Intel can't even do wrong with whatever they do. Yeah,
No.
because there will always be a buyer saying like, "Give me everything you have, please."
Yeah, yeah, and
It's a 16 nanometer. Yeah, I don't care. Give it.
and that's why we have all these countries fighting. Like America are giving incentives to keep these companies and keeping them America and keep the supply chain, because it's going to be so important, so important. Do you know, we spoke last week and you asked me a question. Will it be a learning experience that I sold Intel? And it could well be. I might have sold them at the wrong time, but who knows? And hey, we might as well talk about our other the company that can do absolutely nothing wrong. They won a huge contract with the US Army, and again, their share price rose on the back of this. I've been waiting for a dip in these for a long time. I'm glad I bought them last year when I did at 200 instead of waiting. But they're just, I mean, what a 21.9 billion contract over 10 years with the US Army. It's just incredible.
And this for augmented reality, right? So I was thinking like 20 billion. I saw that they want to put it on, what is it, 100,000 soldiers.
Yeah.
What are they?
Yeah.
What are they going to use it for in the field? Because 100,000 are a lot of soldiers, right? And I was really actually wondering about the practical application of this, because a HoloLens is not an easy device by itself. So I'm really wondering how will they use it? And
Yeah, well, from my vague and very basic understanding is that it'll enable them to use like hand and voice gestures, so they're not shouting across and maybe giving them an advantage that way. But I mean, that's just the
yeah,
way things are going now, isn't it? It's crazy to think. I mean, we're going to have
yeah.
augmented reality in the military.
Well, I hope they will have better batteries than an iPhone, because imagine you're somewhere in Afghanistan in the desert and your battery starts heating up. Yeah, I mean, the reliability I think is quite important in such battle situations, if they are
Yeah,
using it in the battles. Yeah.
yeah. Hey, look, I'm pretty sure they might think of something like that.
Yeah, well, I've had a HoloLens in my hands like 2 years ago, and I can tell you it was really, really far from, I say, practical, in the sense of that I could see it being used on such a large scale.
Hmm.
Yeah, maybe a doctor or something like that in some situations, but on such a scale, I couldn't imagine that would happen now already. So it's a big thing. Over 10 years, I think, right? The deal is. So
Yeah, yeah,
there's a lot of development behind it, I think,
yeah.
still.
But it's more positive signs and more moves that Microsoft are making, and we know from the past anything they seem to do turns to gold. So I'm sure this
Yeah,
might be no different.
true that.
Okay, so we'll move on to our main topic, and I'm excited to hear about your quarterly update on your portfolio.
Yeah, actually, this is so interesting, right? Because we're dividend investors. And if I look at my value of the holdings, they went really, really a lot up in quarter one. And I think that's to do with the shift from tech to value stocks. And I was heavily invested, of course, due to the nature of my investing style in such kind of value stocks. So maybe that's the most awkward for me, is that my portfolio went up with 15.5%, which is a lot, 15.5% in a single quarter.
Mm-hmm.
12% of that is due to organic growth. The other 3.5% is due to new additions. So this is massive for me. I hadn't had such a growth in a single quarter in the last 3-4 years from organic growth. But then from a dividend point of view, with the dividend announcements, there was a small growth. I haven't actually calculated the exact number because I do that on a yearly basis. We have seen, of course, a small dividend cut from Danone and Red Electrica potentially there. But overall, most of the dividends have been growing. I think those were the two dividend cuts that I had. So from that point of view, it looks quite good. My net dividend income year over year has really nice numbers. January was 47% more than last year. February was 17% more than last year. And March was 33% more than last year. And March is for me the largest month of dividends in this quarter. And on average, it grew by 29% compared to last year. And that's mainly a result because of my aggressive buying last year in March and April at the depth of the Corona crisis at that time. And it's paying me literally the dividends now, both in when it comes to portfolio growth and value, but also in the dividend growth. It's really that period that is really, really driving these numbers. So it is just for me a confirmation that buying at such a moment and that I kept my head cool for the first time in such an experience that really did me well. So I'm actually just looking forward for another 30-40% crash anytime soon. So which companies did I then buy? In January, I bought 2 times Realty Income, and I bought 3M. And in February, I bought Unilever and Ahold Delhaize, and I dripped my shares in Royal Dutch Shell. This is slightly the amount of money that I invested is slightly above what I usually invest. So I've been withdrawing a little bit from my war chest here, just because I couldn't, let the opportunity that Ahold gave me pass by, because they suddenly dropped to 22 something, and yeah, I just had to buy them at that time, which was my second purchase in that month. So that's what I've been buying, and I've been selling Philip Morris. My wife spoke to me when she saw my annual report and said, "What is Philip Morris there doing?" And I felt like, oh fuck, I still have it in my portfolio, tobacco stock. So literally, I went to my laptop and straight away hit the sell button because she was really, really angry on me. So Philip Morris is out of the portfolio. It was literally like less than 1% position for me. So it doesn't hurt either. Quickly, largest sector, consumer staples, like last quarter. Microsoft is still the largest company with around 8%, and also no change in the biggest dividend payer, which is Omega Healthcare Investors. It's a real estate investment trust. And my projected annual dividend income is currently covering almost 29%
Wow.
of my let's say my future expenses, and it is an uptick of 1.5 or 2% compared to the last quarter.
And what was it this time last year?
I have no clue. I would need to look it up. Probably like low 20s, something like that.
Yeah, so you're having a really nice year, and I think as value investors, we're having a nice quarter this time. I think all of us can start to see this shift from tech to or growth even to value is starting to benefit us a little bit.
Yeah, but you know what my issue now is that it's hard to buy companies. Everything feels so expensive. So
Yeah.
I rather didn't see this increase in value, because over the last year it was much more easier to purchase. But since this pickup in March, it became so expensive. There are hardly companies that I really feel like now investing heavily in. Yeah. So everything that I'm purchasing now, I have a feeling I'm purchasing it not at a discount. But well, from the other side, you know, quality is always there, and there's always an undervalued stock somewhere. So
yeah, just trying to find it. Everything seems to be high 20s, nearly 30s in the PE ratio. Just find it.
yeah,
I'm the same. I find it really difficult to pinpoint companies that I'm willing to invest a large amount in at the moment.
So for me at the moment, the two sectors that I still find interesting is healthcare and how is it, and insurance, the insurance industry. Those two. Beyond that, even now with the recent pickup in Ahold and Unilever, as an example, I find them again too expensive. And this is, of course, because I know what I paid for it, like just 2-3 weeks ago. So that
Yeah.
the psychology also plays a role.
And who's your largest gross dividend? Is that changed from last time?
No, that's Omega Healthcare still.
Still Omega.
It's the same. Yeah. It might change because I believe that I can check it quickly. I believe that now Upfee is the runner-up. So if I look at it, it's Upfee and ExxonMobil. So if ExxonMobil will do a dividend increase, or Upfee, it will probably pass by Omega Healthcare's. I don't expect too much from Omega Healthcare anytime soon. Also, if Koninklijke Ahold would increase their interim dividend, let's say, or their forecast, it would be the same. So those three are really the challenges of Omega.
Have you made up your mind on ExxonMobil yet?
Yeah, I want to start reducing it from my portfolio. I am now more thinking about what will I buy in return, because I don't want to sell it and then have the cash waiting on my brokerage account without investing it straight away. So I'm doing kind of my homework, like with what am I going to replace it? Should I stay in the energy sector or not? So, and yeah, I don't want to lose too much dividend income by selling it either. So that's also in the back of my mind. Yeah. So I'm trying to find the right optimum. I'm not in a hurry now with the current oil prices rising and such. I feel more comfortable than I
Yeah.
felt like a few months ago.
Yeah. Okay. Interesting.
Yeah. How about you? How was your first quarter of the year?
Yeah, it's a similar story to what you said. I mean, I think from this time last year, my portfolio has doubled in terms of actual cash amount in the account, and this quarter has grown nearly 20%. It's the biggest jump for me, and actually, I don't track it actively, but I have this spreadsheet that I've kind of gathered bits all over, and it does track my performance against the S&P 500, and it's the first time that I've outperformed it by a large amount in, I'd say, in the last 14, 15 months, which is good to see. But again, it's part of that transition that we are now seeing from growth to value play, and some of my stocks like Royal Dutch Shell and Walgreens were huge value plays, and even Intel at the time as well. Kind of bought them at the lowest points, and they've done me quite well over. I think one of the most interesting things that you might see, because I'm showing you my portfolio, is the change in my allocation from a year ago. So this time last year, I was 97% in US stocks. And as we speak right now, it isn't close to 50-50. Pretty much fit. And that's a huge change. And the reason being is I'm just finding a little bit more value in European stocks at the moment.
Mhm.
So you can see some of my purchases from this quarter. So I bought Vonovia, which I spoke about, which is a German REIT. I bought Flow Traders. And for those that don't know much about them, it was Bears Wolf who brought them to my attention. They're like high frequency traders, and they do really well when there's volatility in the market. And I believe we're going to start to see a little bit more volatility. So it's kind of a bet on that. I've been adding to Unilever when it drops below 45. I bought Red Electrica when it dropped as well. I wanted to bring them up to 100 shares. I had like 60, so I bought an extra 40 of them. I bought, they were a cash secured put that I was obliged to pay. And I bought some Buyer as well. I bought them after the dividend cut. Again, that is more a play for income. I think they will go back to their mean in price, so I expect our price to go up. And for good measure, I think I had some pennies left over, about a couple of shares of Aflac as well. So I made quite some changes. On the flip side, I have sold a few stocks as well. So I mentioned recently I sold Intel. Um, but that's with the intention of buying them back at a lower price. Hopefully, I'm right on that. But I did sell Coca-Cola and IBM, so I wrote a blog post on the two of them and the reason why I sold both of them. I've also sold Medtronic, and the reason was I had 3 or 4 shares, and I just I didn't want to add any more. I think they're too high in price, and I just didn't want to have 3 shares of something in my account, so I sold them and used it to buy, I think, Unilever at the time. I sold Waco. Finally, that was more of a tax harvesting thing, so I sold them at a loss. I sold Intel at a profit. By selling both of them, my capital gains falls under the allowance at the moment that we have in Ireland, so it's all good. What else have we? Yeah, that's pretty much what I sold. So we've had some big changes in my portfolio, and obviously the shift from European or from the US to the European is big. It was intentional. I wanted to have more of an exposure. I wanted maybe 60-40, but it just so happened that I'm finding a little bit more value at the moment. What that has meant for me now is my largest gross dividend payer has switched from AT&T, which remember was 10%, now to flow traders. And flow traders they pay some juicy dividends when things are going well. They can pay up to 15% dividend yield. So it's a little bit, it depends on how much they make and how they perform, but
So they pay based on payout ratio. So it's not for you like a dividend growth stock, just a dividend stock.
Exactly, yeah. It just so happens that they've been growing it the last 5 or 6 years, but it's not guaranteed to grow. But the rate is so high that it more than makes up for that.
Yeah.
My largest sector now by far is consumer staples, and again, I've been buying Unilever and Ahold on that, so that has really jumped them up a lot. Healthcare has now become my second largest sector, followed by utilities. And utilities are there because I bought some more Red Electrica, but then on the back end of last year, I bought some Energas as well, to kind of offset the two of them together. So some good changes. My projected annual dividend now covers 7.4%. And this time last year, so just in a year, it was under 2%. So it's huge. Like even just 1 year of this has seen massive changes in the portfolio.
Yeah. Do you feel that the quality of your portfolio also increased in the last 3 months?
Yeah, I think so. I've been trying to focus a little bit more on quality. I have some value plays, and look, there's lots of other value plays out there, and Cisco could be another one, for example. But I feel like I exposed myself with a couple of companies. I was happy at the time, but I wanted to focus more on quality. I do really want to start buying my top tier, Microsoft, Johnson & Johnson, a little bit more, but they're just too expensive right now.
Yeah, I struggle with the same thing. My tier 1 companies, they are so expensive at the moment, and really the market needs to cool down a little bit. This is not normal, really not.
Yeah, I mean, look, patience. We always speak about patience, and that's what we just need to be. It just feels like this time last year I was stocking up more on tier 4 companies. Now I'm more higher end tier 3 to tier 2, and I'm hoping tier 1 now will be towards the end.
But the risk is that we start unconsciously yield chasing, right? Because there's nothing out there really, and that we then start getting poor quality into the portfolio.
And looking at my portfolio yield, it's 5%, which I feel is very high. But I believe AT&T, Energas have huge parts of that. Also Altair as well. So they're three really high dividend stocks, and flow traders as well. So that's probably abnormally taken up. So the 4 of them are higher than normal. But I do have some average stocks as well, like Microsoft, which is 1%.
Yeah. Okay. And what is your thoughts? Because I was surprised a little bit that you bought Ahold, of course, because I didn't know you were so familiar with the stock, and now your option got called. You are exercised. So how do you feel about that? Because I know you're new to option trading. Did you do, for instance, your homework on Ahold first, like you did with IBM or Cola, or?
Yeah. So I mean, I've been reading your blog. You've spoke to you a lot about the company. I've been speaking to a lot of people. They are pretty big in Europe, huge consumer staples. So I picked a price that I'd be happy to buy them at, and I wasn't.
Mm,
So I I've I think I did the put option for 3 months in a row, and I
yeah,
got called. So I wasn't disappointed at all. I was quite happy to own them actually.
yeah. Okay, super. Yeah, I didn't talk about my options either, but my Shell, I've got an option on Shell still with a strike price of €11. It's a call option.
Hmm.
No, sorry. Yeah, it's a call option. €11 for September this year, so it's now on what is it? Around €600. Um, so it's not. I haven't sold it yet, or something like that. I will just let it expire in September next year, or
Okay.
September this year. But that one might also give some profits into my portfolio, which I can then use again for buying some dividend stocks.
Yeah, I've started to do a little bit more option trading. I don't know if you're familiar with the wheel strategy. It
Yeah,
kind of popped up on my radar where you sell puts on companies you don't mind owning, and then if you end up owning them, you sell covered calls. So I have a call set up with someone actually. We had a call last week, a member of the community, and we just chat about our ideas and stuff like that. So something that I've been looking at the last month or two, and options have become a little bit of a bigger portion of my income at the moment as well.
yeah. Yeah, the only thing we need to, so I do it as well, right? I usually have 2, 3 options at the same time for sale, or I said in active.
Hmm.
But last year we had a margin call, right? Or not, we had a margin calls, but we had a crash, and I saw that the bank started sending me messages like, "Hey, EDGI, you need to have some more cash behind because what those nasty banks always do, they say, for instance, the margin is now 20%, but then during a crash they suddenly raise it to 25 or 30% to
Mm.
in line with the volatility." And then I think like, come on, just keep the same margin. But what it then required me last year is to transfer some money to oblige to their request, right? So that's the only thing I always say with options. It's really nice, but people watch out with margins when you're
Mm.
for the people that are new to this and listening. You will not notice it now. Now it looks all good, but once shit hits the fan,
Yeah.
you might suddenly need to sell it at the bottom with a big loss, or you need to add lots of additional cash if you are not, if you are overexposed. Let's say it like that.
Yeah, I think it's important to say that it's all cash secured puts that I'm doing, and Ahold is an example. Intel is another one that I'm doing. The companies I do want to own, and at a price that I want to own them at. So that's
Yeah,
super important. So I have the cash. I don't use margin to an extent because I don't want to have to scramble to sell other
yeah.
stocks to pay from. So
Okay, so all in all, good quarter for you as well. But we wish that our portfolios wouldn't be rising too much like this, so that we could buy more dividend stocks at a lower price. I guess that's the typical thinking we all have. But I wouldn't lie if it feels one time nice to say that my portfolio grew more than 10% in a single quarter. It feels nice for the first time in few years. I won't lie.
it, it's a double-edged sword, isn't it?
Yeah, yeah, exactly.
You want it to grow over time, but then you don't want it to grow when you're buying. It's hard.
Cool. So let's then go to one of our favorite sections of every week, and let's look at some of the listeners' questions.
So the first question is from Phil, as per usual. And he asked us, he said it's not related to the topic, but it's a philosophical question. When should an investor be more greedy? The first time you open a position or when you add more later on?
So I'm usually more greedy later on because usually the first time when I open a position, I would do it at a fair value or even slightly above if I really want the stock. But it's for me usually an entry position so that I get used to the stock. After that, I usually want to go more full in, and that's usually during averaging down. it could be averaging up, but averaging up only if my fair valuation increases as well due to recent earnings numbers or something like that.
Yeah, I have a little bit of a different take. So for value plays, I'd be a little bit more greedy at the beginning because you're betting on value and you're expecting the price to rise over time. And I don't know, I'd much rather buy it at a lower price than a higher price, and that's exactly what I did with Walgreens and Royal Dutch Shell. For bigger companies and for companies that I expect to be tier one, I will buy in smaller trenches and just keep analyze them a little bit deeper because they are my cream of the crop stock. So
You bring up a good point, but for instance, I'm now looking at Allianz, right, to enter a position in, and they are not cheap at the moment from that point of view.
Mhm.
I think they're around fair value. So for that point of view, I will probably do an entry position.
Yeah.
But later on, if they would drop, I will probably go big on. But if Allianz would now be, let's say, 20, 30% undervalued, yeah, like you, I would go more full in straight away. Yeah.
Cool. Phil does ask us a second question about benchmark, but we have questions later on that, so we might just tie them all in together.
Yeah.
If that's okay. So the second question then we have is from Taurus Invests, and he asks us, must a stock have a minimum dividend yield to entice you?
The answer is most of the times yes. So my minimum dividend yield requirement is 2.75%. Lower than that, I'm not too interested because usually the growth rates are not 15 or 20% per year in dividend growth, and I don't want to. I mean, if I buy now a stock for 1.5%, I don't want to wait 20 years for it to get to yield on cost of 10%. I want to retire earlier from that point of view. So yes, it does play a role. But again, there are always some exceptions. If I could do a package deal with buying some high yielder together with a low yielder, I might do it. But as a standard rule, I don't purchase below 2.75%.
Yeah, mine is 1.5 times the average S&P 500 dividend yield. That's what I typically look for. So, but like you, there's always exceptions. Microsoft is one, and there's other companies out there that are sub 1%, but their growth rates are so high that it more than makes up for it.
Cool. So then Adi says, I think maybe that's here where we can start looking at the benchmarks. He asks, having a mix of European and American stocks, which is the best benchmark that you use? Or which is the benchmark that you use?
Do you know what? I've switched. So in the beginning, I used to be constantly focused on benchmarks and tying them to ETFs and sector ETFs and seeing if I'm beating them. I don't really care anymore. I'm honestly, I feel like you're constantly looking at your portfolio, is it going up and comparing it, and then if it's not beating it, you're going to make rash decisions. You know what I mean? You're going to say, okay, what will I buy? Will I buy higher yield to try and beat the benchmark? I've learned to just be happy in what I have and not look at benchmarks. If I wanted to match a benchmark, I'll just buy ETFs. I mean, let's be honest. They don't beat benchmarks, but they'll match them, and that's there's not too many investors out there that will beat the benchmark over time consistently, and most people that tell you they do are probably telling porkies. Let's be honest about it. So I don't care too much about it. I'm happy to see year on year, quarter on quarter growth, to see my income increasing after tax. That's what keeps me motivated. I've gone past looking at benchmarks.
Yeah, and those are actually also a second and third question, right? About the importance of beating benchmarks and how the performance was. So I have exactly the same. I think my portfolio it's impossible to benchmark it from that point of view because it's unique to my own profile. And by the way, I can't be bothered either about it. My main benchmark is, have I done better in this quarter than last year around this quarter? Have I improved both in dividend growth and also both in quality and lessons learned? That's most important. Why is there no ETF or benchmark that I can benchmark with? I did quite some research on dividend ETFs. Many of them, they don't grow their dividends year over year because there are lots of dividend cuts in there, and that is based on how they are designed. For instance, the European Dividend Aristocrat ETF, they rather take the 30 highest yielding ETFs, and then when they cut, you see it back in the numbers. Or you've got the Vanguard Dividend ETF, which is running at a 1.5% yield, because they also have Microsoft, Apple, and all these tech stocks in there that pay dividends. So my how is it? My portfolio is so hard to compare to even just an ETF that it makes no sense for me even to benchmark, because I will never be able to benchmark apples with apples. So that's the second reason.
Yeah, and I mean, look, everyone can always do better. No matter what returns you get, you'll always feel like you can do better. And like you, if I'm improving, my analysis is getting better. I'm starting to understand more and more of the financial statements. You can see if you look at my first deep dive that I did on, I think it was ADP, and then look at my IBM one, you can see how far I'm after coming as an investor. And I can see that, which is important for me. And just as I said, to see that growth year on year, quarter on quarter, that's enough. That's enough for me.
Yeah, and it also aligns fully with our goals, right? And I understand why people say, like, well, you could have put your money elsewhere otherwise, like in an index fund. Yes, that's true. But like I said, index fund, like how I want to design it, doesn't exist. So effectively, my portfolio is my own ETF. It's low cost as well.
Yeah.
So yeah.
I can compare this to paying tax. So in Ireland, if you tell people you invest in dividend stocks or anything like that, they'll tell you you're crazy and you're paying too much tax. And a pension is the most tax efficient, and it's how you make money quicker, blah, blah, blah. And yes, that's true. But it doesn't align with my goals. I cannot access that money until I'm nearly dead. It's not for me. I'm paying more tax now, yes, but I'm also reaching my goal faster by doing it now as well. I don't have to wait until such a time. And I feel it's the same with benchmarks. People get pulled into, oh, you need to be the benchmark, you need to do this. You're not a good investor unless you're beating the benchmark. That's all bullshit. I mean, just focus on your end goal and take those baby steps. And that's the way to a happy life, I feel.
Yeah, exactly. I agree with you. He also asked another interesting question. So let's take that one quickly as well. So which of the stocks in your current portfolio will you see as a 10-bagger in the future?
In my portfolio, none, because they're not that type of company. In my son's portfolio, he has Roblox, he has Biogenomics, BNGO, the ticker symbol is, and they have potential to be 10 baggers. But I mean, I don't see the likes of Walgreens or any of these being 10 baggers by any means.
Maybe 100 years from now.
I'll be dead in 100 years.
Yeah. So mine, who could potentially become a 10-bagger, is Microsoft, if it still is able to double in share price. And I know what people think now, like, oh, but that will be multi trillions. Yeah, of course. I mean, there was a time, there was a first company that was $1 billion company. So, but for me, Microsoft, I think, is now at 4.5 times for me. So it's on its way to 10 times at a certain moment.
Nice. I hope it gets there.
Yeah, me too. And I hope with the yield as well, with the dividends, because I prefer dividend 10 baggers. Yeah. And have you done that analysis, by the way, once, a dividend 10 bagger?
No, I haven't compared which one would be first.
Yeah, so I sometimes do that when I analyze a stock. I'm looking at how many years it took the stock to 10x their dividend. Yeah, like Walter Kluwer or something like that. And that's interesting because sometimes, they were low yielders in the past. And then you have, let's say, payout increase in payout combined with dividend growth itself, that you get to a 10-bagger quicker. So that's also interesting philosophy to look at.
Yeah, that's a nice exercise to do. Actually, I might try that and see which one of my companies will get there first.
Yeah, exactly. Okay, next one from Dividend Wave. IBM and Intel, we are done with that, or you are done with those. You sold them. Is there anything else that you're having on your list, EMF?
No, I kind of went through what I sold this month, and that's all I want to sell for now. I think I'm at a place in my portfolio where I'm happy with each of them. I finally got rid of Waco, which was like a thorn on my side. Um, and I'm not done with Intel. I'm just hoping to buy them at a lower price. I'm gambling with Intel.
Good. So let's move then to the next. We still have quite some questions, I see. Thiago Diaz, what's your year-to-date return? Who was the best performer and who was the worst? I think we spoke about most of those, except from who was the worst performer. Do you have any insight in that?
My worst performer was probably Waco. I don't actively track it from that point of view in terms of year to date, but Waco have certainly been one of my worst.
Yeah, so I don't know. I don't track the performance of individual stocks on a quarterly basis. So I really wouldn't know. I would need to go to my brokerage account for that, and but I really wouldn't know.
I just had a quick look actually. It's Red Electrica because
Oh,
they had a big drop in
yeah.
price.
Then it's
S-
probably the same for me, Red
Yeah,
Electrica. Then yeah.
so they're minus 7% for me at the moment.
Okay, good. Okay, then we have a question from Wolf of Harcourt Street. What is an under the radar stock that you think will benefit from economies reopening?
I mean, I think stocks in the aerospace industry or maybe cruise industry, I think they'll start to bounce back once we start opening up, really.
So I think that some of the stocks have already appreciated in share price, right, since the bottom. I personally think actually Danone, for a simple reason, their water business was brought really their earnings under pressure. And if the economies open again and people go to restaurants and buy, their waters, I think it will return to pre-earnings and maybe even better after that.
Cool. The Stoic Trader asks us, do we calculate performance using TWR, which is time weighted return, or IRR?
So I stopped using it. In the past, I used internal rate of return. But what what does it give you if you see, let's say and it was actually I think the annualized, right? What does it give me if I see that from Microsoft that I'm holding already for 5 years or other companies? It doesn't. It is nice for after the first year to see it a little bit to validate your purchase. But after that, it adds no value anymore for me. I just expect the company to grow over time and then let the compounding do its work. And the IRR, these are things looking back. What you're effectively, if you look at those rates, you're just all the time confronting yourself with your purchase price. Yeah,
Yeah.
and it's a fact. You bought it. So the only question you can always have when looking at your portfolio: do you want to sell it or not?
I,
Yeah.
I'm like you. I don't actively look at them, but I do have a section on my tracker that has the time weighted return, which I can tell you is 8.1% annualized at the moment. That's what I'm currently at, but I don't pay too much attention to it.
Cool.
Okay. Eli Snowball has asked us, according to this graph, and he showed a graph, consumer staples have been the worst sector in Q1 21. It's still hard to find a cheap one. What do you think of these, or do you see more value in European staples?
Yeah, definitely the European staples. I find them of more value than the American equivalent. I think in America they run so much up, but still, I mean, really, if you want to enter positions now, I think Ahold and Unilever still give a good value as an example. Danone as well. But of course, they had a recent dividend cut be announced. But I think there are quite some nice consumer staples in Europe still that you can pick up if you want to add some to your portfolio. In America, it's indeed harder. Just look at Clorox as an example and their share prices. Look at McDonald's, which I think is consumer discretionary. But just look at those Procter and Gamble. For me, they are so expensive. All Walmart, their multiples. I think Europe is in general much cheaper than the American continent at the moment.
Yeah, definitely much cheaper, but as we know, not as a little bit more risk when it comes to dividend safety. I think we have to agree.
Yeah, that's true. Okay. Then Tommy asks about what we think about Allianz. So I think I answered it before. I just think it's a good insurance company, the biggest even I think in asset management and such in the world. So for them to grow rapidly is of course a bit more difficult, but I find it a high quality company. It has survived really well the Corona crisis. And there was, of course, a lot of pressure on the financial sector, specifically from the French regulators. And in Germany, it was also not too easy, let's say, or Europe in general. So, and they did well. They maintained their dividend. They didn't cut it. So for me, it's a really nice one. I think it's around 4% at the moment. So it's also an attractive yield, I would say, if you compare it to the rest of the dividend stocks.
I believe I saw an article you wrote about 4 European stocks, and they're in there. Are they on someone on a blog?
Yeah. I wrote it for Jung in Rente, a German blog. I gave their 4 European stocks that I find currently attractively valued from the point of view, and Allianz was on that is there indeed.
Cool. We'll throw a link in the description.
Definitely.
You can read about them.
Yeah.
Okay. Rafa has asked us about our opinion on Broadcom.
Yeah, I don't like Broadcom because I was like 5 seconds away from purchasing it last March for around, what was it, $150, $160. And now when I see the share price, it just makes me feel miserable. I was thinking like, because I wasn't totally familiar with the stock yet, but I was familiar enough that I usually buy when there's not such a stress. But now I wanted to know twice as much what I was investing in.
Yeah.
And that's why I, in the end, got cold feet and I didn't purchase it. But I think it's a high quality stock. I find it quite expensive at the moment. But I just regret not buying it at the time when I should have.
And they have a PE ratio of 55.21.
Yeah, it's crazy now. That's what I mean. It's crazy now, but it's a high quality company. Yeah,
of course, but not at those prices. Okay, and the last question, it actually came to me in an email from Alex, and he asks us, do we use ESG or SRI metrics when deciding which stock to include in your portfolio?
Honestly, not. I do know that I read even the other day research that ESG stocks have generally performed better than non-ESG stocks over the last few years. My only ethical litmus test is asking my wife if I'm okay to buy this stock. So that's and if she agrees, then I know it's ethically improved.
you must have forgot that question when you were buying Philip Morris.
I never told her that I bought it because I bought it back in 2014. But yeah, she's a bit more picky on my portfolio, or on it's actually our portfolio. She just outsourced the whole management to me. How about yourself?
Yeah, I had a conversation with Alex on this, and I sent back one index. It's the Spider Stocks Europe 600 ESG index. And I just find it a little bit hypocritical. Okay, we talk about ESG stocks and we're talking about all these good things. They don't have tobacco stocks. Great, I understand that. why would you have alcohol stocks? They're both addictive drugs. They both do damage. Where's the definition there? Why have tobacco, or why not have tobacco but have alcohol? They have Volkswagen in there. Let's have a look what they did with their emissions in the States and the lies they told and all this carry on. It's on Netflix, Dirty Money. I suggest watching it. They're in there. Is that not ethical? I mean, should they be disqualified from it? And then we look at some of with all these talks with Chinese labor and all this, and you have stocks in there like Inditex that have been caught up in scandals like that. So for me, it just seems hypocritical in some of these things. Well, the question I had was, where is the line? What is your line? What's your ethical line? And that's what I find really, really hard to define. Where do you draw that line?
But ESG stocks are so popular at the moment. Yeah, there's so much marketing around it that people want to buy it, and it becomes a requirement for people. So fund managers start to only have stocks of ESG nature in their portfolio. So that's why tobacco stocks are just not getting up like British American tobacco.
Yeah.
But to your point, it's hypocrite. So what I often do in a stock analysis, I go to the violation tracker. I can put the link in the description. You can visit it. You can look at the company and you see all the violations and the fines and everything that they have had over the last years. And it also includes European stocks. And this violation tracker is always a good indication for me, because for me, this is a result of management. And if you think about it, then a bank like ING doesn't belong then in any index that has something to do with ethical nature or something like that, because money laundering all over the place. There's always something with this bank. And anyway, I don't want to start about banks again. Violation tracker.
You could take out banks in general, not just one bank. You could take out 90% of them. But it's just, for me, I just don't know where that line stands. But to your point, I did finish one of my emails to him saying that this question is super, super important. We're getting it an awful lot. It is definitely on the minds of investors of our generation and the generation coming after us. There's no doubt about that. And if you're going to pick a stock or a company, should I say, that you believe in for the next 10 years, it's probably a good place to start.
Yeah, I asked this also one time on Twitter when someone said something like to me, like, don't you have bad feelings about owning an oil and gas stock or something like that? And then I asked them, so how do you define this? And this person had an okay answer in the sense of depends on what do you sleep well with, right? But it's I sleep well in general, so it didn't make it easier.
Do you know what? One question I would ask, and I would probably ask that gentleman is, okay, you won't invest in them. Do you buy their products? If the answer is yes, why would you not invest in them?
Yeah, and this is often the issue that I have when people talk to me about oil and gas stocks, right? In the same time, they're still stepping into an airplane, stepping into the car, buying clothes. So I was actually wondering, right, if there's, for instance, an ETF that is called Woke, with the ticker Woke, because I think now that I got an idea that we need to have a ticker Woke, and I think many people will be interested in that from a marketing point of view.
Yes, so. Hey, you might be after giving away a multi-million-pound idea there for free.
Yeah. But this is not for me to bash people that have Woke, right? But I think if we start looking at that, I find usually the people that are woke as such, I find them the most thoughtful people that really consider things. They don't just follow blindly ESG or something like that. So, but I just Googled. I don't see so quickly that there is an ETF that is called with the ticker symbol Woke. But honestly, I wouldn't know what to put in there. Literally, healthcare to high drug prices. You can go to all these brands like Nike, and there's always this smell of child labor around it. Yeah. So I come back to Danone then again, and such companies, Unilever. They are really embracing the stakeholder part, but even there, you can always say something about, okay, but the exploitation of land for producing their food, but they're aware of that, right? They're actively working on that. So for me, I rather prefer companies that know where they are now and try to, for instance, reduce their footprint with 20 to 30% over time, do no harm, and I rather like that. And then suddenly British American Tobacco becomes really interesting if you start to see, if you look at their report. Damn, if you would truly believe them, you think like they invented God. Yeah.
Making it better tomorrow, is it?
Yeah, building a better tomorrow. But from the other side, if you look at their statistics then and in their report, then you wonder, why are they not in the ESG? Yeah, from that point of view. So anyway, really long story, and I think we could talk over a pint of this for a really long time, but it's really hard to draw a line somewhere.
Yeah. No, it's a great question, and one that will draw out many opinions. I'm not saying we're right. I'm just asking questions that I feel that I would ask myself.
Well, and with that, I think we have a nice ending of this show again. And yeah, it went really quick again. Portfolio Q1 2021. Well done, EMF. I hope that Q2 will be just as well from a dividend growth point of view. We'll hear that in the beginning of July. And for the people that stayed with us until now, we have also an announcement, because next week our podcast will be a bit earlier than today. It will be recorded on Wednesday, and maybe you want to take the scoop away?
Yeah, we have a guest from the United States. Our first guest actually from that side of the world. Ian Lobdo is coming on. A huge personality. I'm sure most of you follow him on YouTube and Twitter. I can't wait. I can't wait to have him here. I can't wait to chat to him. I can't wait to pick his brain. So excited for it.
Yeah. So make sure you tune in next weekend. We'll release the podcast again around Saturday next week. So tune in and listen to our conversation with Ian Loppuch. And for now, everyone, have a happy Easter. Don't eat too many eggs. Think about your cholesterol. Or take some vegan milk from Danone instead. Alpro, good brand. And see you next week.
Adios. See you later.